So what does deflation, when prices start falling, actually look like, actually feel like? A good window is right here in Japan.
The Japanese yen surged to a 4-year high against the US dollar, while the US durable goods orders crashed to a record low. How did this happen, and what does it mean for you as a Forex trader or investor? Let's find out. On February 27, 2024, the Forex market witnessed a shocking event that sent ripples across the global economy and the financial markets. The Japanese yen, which had been trading at around 110 per US dollar for months, suddenly surged to 100, a level not seen since 2016. At the same time, the US durable goods orders, which measure the demand for long-lasting manufactured goods, plummeted to a record low of minus 10.5%, far below the market expectations of 0.5%. Japan's core consumer inflation, which excludes fresh food prices, rose 0.8% year-on-year in January, beating the market expectations of 0.7% and the previous month's 0.7%. This was the highest inflation rate since April 2019, when the country implemented a sales tax hike. The inflation data suggested that Japan's economy was recovering from the pandemic-induced recession, and that the Bank of Japan, BOJ, might have less need to maintain its ultra-loose monetary policy. The BOJ has been keeping its short-term interest rate at 0.1%, and its 10-year government bond yield target at around 0% since 2016 as part of its massive stimulus program to boost inflation and growth. However, some analysts have speculated that the BOJ might consider raising its interest rate or tapering its bond purchases in the near future, as the negative rate policy has hurt the profitability of banks, and the bond market has become less liquid. In contrast, the U.S. core consumer inflation, which excludes food and energy prices, slowed to 1.4% year-on-year in January, down from 1.6% in December, and below the market expectations of 1.5%. This was the lowest inflation rate since July 2020, as the pandemic continued to weigh on the demand for services such as travel, recreation, and healthcare. The inflation data indicated that the U.S. economy was still facing deflationary pressures and that the Federal Reserve might have more room to keep its accommodating monetary policy. Since March 2020, the Fed has slashed its benchmark interest rate to near zero and launched an unlimited bond-buying program in response to the economic fallout from the coronavirus crisis. The Fed has also adopted a new policy framework that allows inflation to run above its 2% target for some time before raising interest rates. The Fed has signaled that it will not tighten its policy until the economy reaches full employment and inflation is on track to exceed 2% for some time. The divergence in inflation and monetary policy expectations between Japan and the U.S. was reflected in the exchange rate of the yen and the dollar. The yen appreciated 0.2% against the dollar on Tuesday, reaching 150.39 yen per dollar, the highest level since November 2020. The yen is widely regarded as a safe haven currency, which tends to strengthen during times of uncertainty and risk aversion. The yen also benefits from Japan's large current account surplus, which means that the country exports more than it imports and thus has a net inflow of foreign currency. The dollar, on the other hand, depreciated 0.1% against a basket of 6 major currencies on Tuesday, falling to 103.82, the lowest level since February 18th. The dollar is often seen as a reserve currency, which tends to weaken when the global economy recovers, and investors seek higher returns in other markets. The dollar also suffers from the U.S.'s large fiscal and trade deficits, which means that the country spends more than it earns and thus has a net outflow of foreign currency. What caused this Forex shock, and what does it mean for the world? The main trigger for the yen's appreciation was the Bank of Japan's BOJ surprise announcement that it would end its ultra-loose monetary policy and raise its policy rate from minus 0.1% to 0.1%. The BOJ also said it would reduce its monthly purchases of government bonds and exchange-traded funds, which had been part of its massive stimulus program since 2013. The BOJ's decision was motivated by the improving economic conditions in Japan. which had been boosted by the successful hosting of the 2020 Tokyo Olympics, the recovery from the COVID-19 pandemic, and the increased trade and investment ties with China and other Asian countries. The BOJ also cited the rising inflationary pressures and the potential risks of prolonged monetary easing, such as asset bubbles, financial instability, and fiscal sustainability. The market reaction to the BOJ's announcement was swift and dramatic. Investors who had been betting on a weaker yen and a stronger dollar rushed to unwind their positions, creating a huge demand for the yen and a sell-off of the dollar. The yen's appreciation was also amplified by its safe haven status, which attracted investors seeking refuge from global uncertainty and volatility. On the other hand, U.S. durable goods orders were dragged down by a combination of factors, including supply chain disruptions caused by severe winter storms in the U.S., ongoing trade tensions with China and the European Union, labor shortages and wage pressures in the manufacturing sector, and reduced consumer confidence and spending amid rising inflation and interest rates. The Forex shock had significant implications for the global economy and the financial markets. For Japan, a stronger yen meant a lower competitiveness of its exports, which accounted for about 15% of its GDP. It also posed a challenge for the BOJ to achieve its 2% inflation target, which had been elusive for decades. However, a stronger yen also had some positive effects, such as lowering the cost of imports, especially energy and raw materials, and enhancing the purchasing power and living standards of Japanese consumers. For the U.S., a weaker dollar meant a higher competitiveness of its exports, which could help boost its economic growth and reduce its trade deficit. It also made U.S. assets more attractive to foreign investors, who could benefit from higher returns and currency appreciation. However, a weaker dollar also had some negative effects, such as increasing the cost of imports, especially consumer goods and services, and adding to inflationary pressures and interest rate expectations. For the rest of the world, the Forex shock had mixed effects, depending on their trade and financial linkages with Japan and the US. For example, China, which was Japan's largest trading partner and the US's second largest, faced both opportunities and challenges. On the one hand, China could benefit from the increased demand for its exports from both Japan and the US, as well as from the lower cost of its imports from Japan. On the other hand, China could also suffer from reduced demand for its exports from other countries that compete with Japan and the US, as well as from capital outflows and currency depreciation pressures. That brings us to the end of this video. What do you think about these sudden changes? Could this be a turning point in the Forex market? Please share your thoughts in the comments below, and don't forget to hit the like button, share it with your friends, and subscribe to our channel for more.